This short clip is from my live trading room. You can engage directly with my fabulous team and me at LaDucTrading.com for all our research and trades. Or for just my daily live streams, you can access via YouTube memberships. All links are in the description. And surprise, surprise, in a thinly traded weekend futures market, thinly traded, keywords, hyphenated, whatever, weekend futures market, we have a ceasefire, sort of, kind of, not really, that has nonetheless caused crude to come on back down. And as you can see from this chart, it's actually exactly from this pre-Iran gap fill down here, about 67.90, right up into and overshoot through my 91 price target. You can see the overshoot actually right back up to this cute little resistance line of thereabouts 93.62. I can't tell you what it hit exactly, but anyway, that was 2 days ago. And then on Friday, we had a little digestion sitting on top of that trend line for crude oil, literally closing right at that kind of 91 level. And then we had the probably fake headlines because Iran has said they will never negotiate with the US, blah, blah, blah. There's just complete Axios fake headlines here stateside, which is causing all kinds of market manipulation in stocks, in bonds, in oil, and more specifically, bond bulls need to defend here, is what I said last week. And sure enough, as oil comes down, yields come down, bonds go up, equities go up. That's how the ball game's played. So we did have this shake and bake exactly in this channel, so this big old channel from roughly 94 to 84 in crude. It perfectly tagged, got supported. Look at this. I mean, it's just perfect. So anyway, what I'm looking for next is we're either going to have this repression of oil price, although there are very few levers for the administration to trigger other than futures manipulation because they do not have a ceasefire, short of just relinquishing control, which, you know, my baseline bet for months and months, even before the first war was dropped, this would be a protracted Middle East war, that Trump has had his sights on Iranian oil for 40 years. Karg Island is sadly in our future. So we just have to kind of wait this out. This is a long game. But in the short duration, this technically softening so that equities and bonds can catch a bid is not a surprise. So I said it wouldn't surprise me if we come back here and kind of form this digestion. And now we have to see if it actually is going to come on down, and there is EIA coming in with global falling oil demand. We've got some other reports of global oil falling demand. Then that kind of helps keep it from getting too out of control higher, energy crisis type of higher. But we also have those oil inventory levels at the SPR, Strategic Petroleum Reserve, that have been drawn down. We definitely have Red Sea and Strait of Hormuz under lockdown, which is very, very, very disruptive to supplies. Same thing, but the second go round. I heard a great expression, the second mouse catches the cheese or something like that. Basically, the first time, everyone gets faked out. They go long and strong. The market is supported with all this inventory release and, of course, market manipulation and, of course, ceasefire headlines and, of course, memorandum of understanding attempts and more and more and more and more and more headlines so that the bulls get shaken out. The second time is when it actually really matters. So if this does form a little kind of like, think of this cup and little handle. So we go sideways 84 to 94 roughly in crude, and then we get and stay and move higher. We got troubles. We definitely have troubles. And I am definitely the one who wrote this strange formula a while back. It was actually in March. I'm going to show you this strange ratio that I have. And it was a big picture of this kind of left shoulder, head, right shoulder of a ratio of oil to dollar. And it was back in March. And this 90.9 is a ratio level where I said, if we get and stay above this 1.2, we're not there. We're coming back in. This was a monthly and it got rejected. And basically we came back in and then now we're getting supported again. So we haven't really gotten above some key levels. I'll show you what I mean by that. But basically this is what I'm looking at. If we do get above this intermarket tell of mine, which is going to be in this 1.2 neck of the woods, then we will have the potential for spiking higher oil. And that will be felt in the real market. In other words, the economy, because they've kind of used all their bullets. I don't mean that euphemistically in the war, because that's the reason why apparently they're taking a little pause is because they need to rearm, and it's not so easy. They've used a lot of munitions. But it's also this kind of situation where the SPR drawdown and stealing of Venezuelan oil and et cetera has a capacity. We're at full capacity, right, with those refiners. We're at SPR drawdown when it comes to inventory. So not a lot of levers is what I'm trying to say. So I think we could actually go into risk of higher oil, but we're not there yet. And I do mean much higher oil, so not just 91, 94, what I'm talking about, but it starts to get a supply shock that is felt and moves aggressively higher. So I am definitely tracking that. In the meantime, we do have I'd be looking for this kind of cup and handle idea before moving higher.
Join club to trade with Samantha. Scan this QR code or click the link in the description.